Joining us now, Bloomberg best economist, one of our favorites, John Herrmann, senior fixed income strategist at State Street Global Markets. John, great to have you back here.
Thank you, Carol.
A tough report. I know your research talks about some seasonal variation. So talk to me about them, and should we just kind of blow off this number then?
Yeah. So here we, first thing is, the economy, as you know, is in a soft patch. It's been in a soft patch since the middle of the first quarter. So it was in a soft patch. And we had some quirky seasonal adjustment patterns that just sort of revealed the fragility of the labor market conditions. And here's the seasonal adjustments. If you go back over the last 30 years, what you find is for the months of April, where there's a 5-week survey period, it tends to overstate the payroll gains. And then in the following month of May, when there's a shortened 4-week survey period and a late Memorial Day holiday, it tends to understate the payroll gains. So we had that kind of flip-flop or seesaw between strong April, softer May, and I think it would be just a little bit getting ahead of, getting over our skis if we just project this kind of weakness through the summer. And there's two reasons not to want to do that. The first thing is that the underlying pace of job growth probably, is not as good as what we've been seeing, but it's probably not as bad as what we just saw in this month, first thing. And then the second thing is the motor vehicle sector, by the time the month of June ends, the motor vehicle sector is going to have extremely low inventories relative to sales and extremely low inventories on an absolute basis. And they are going to need to revamp and restart inventories and production as soon as the 4th of July holiday is over. So that should jumpstart the month of July, jumpstart the month of August, and that should help get the economy going.
It's interesting, John. You don't sound too worried. And earlier we talked to White House chief economist Austin Goolsbee, who also doesn't seem too worried either. And he talked about the impact of this jobs report. Let's listen up, everybody.
We should never read too much into any 1 month's report. A moving average and looking at a little longer period is far more accurate representation of the job market. And there's no doubt we face some headwinds and hit a bump in the road.
So, John, a smart guy, but he's, in the White House, a politician. So do you buy what he says? Is he right that this is just maybe a small bump in the road?
The fact is that initial jobless claims have, they hit a low point at the end of March, and they have been, trending slightly higher since then. So the jobless claims suggest that job growth going forward, is not going to be as strong as what we observed in the first few months of the year. So he's not fully divulging some of the weakness. But on the other hand, just assuming that we're going to have payroll growth of 50,000 over the coming, 4 months is probably unrealistic as well. I think the key thing is going to be, the government sector will be continuing to cut. So there's going to be, and you get the new fiscal year starting July 1st for 46 of 50 states. We're going to see some cuts there. So that you have to look at. But it's a question of, can the private payrolls, offset and sort of keep the game going? And that's the real issue. And from that standpoint, growth is okay, not as good as what we've seen.
John, one of the other real issues out there is whether or not we get more easing by the Federal Reserve. We did talk to PIMCO's Bill Gross earlier today. Let's listen up to that, everybody.
We don't see a QE3. I think there's been too much discussion and dissent within the Fed to permit that type of program again. What we do see is an extension of the language. The language, of course, speaking to an extended period of time.
All right, so Bill Gross doesn't think we're going to get a third round of quantitative easing. John, do you? And if we don't, is that even more problematic for the economy?
The economy, let's just review where growth is going. We had 1.8% growth in the first quarter. Our own tracking estimate for the second quarter is a little bit below 2. So that's, that looks like a soft patch. For the third quarter, if we do get the ramp in motor vehicle assemblies, we're growing closer to 3. But if the vehicle assemblies, for any reason, whether it's disruptions from Japan, you name it, if that comes in, much less than expected, then we're growing again closer to that 2% handle. And 3 consecutive quarters of that is, that's below the economy's potential. And that would create some problems for the, fourth quarter and for the first quarter next year. So I think it's a little bit, we have to watch the data. Chairman Bernanke is going to see how third quarter unfolds. But I think, to rule him out completely, I think, is a little bit, not quite with it.
Sounds like it's too early. Hey, John, always good to get your thoughts and input. You take care and have a great weekend. John Herrmann, everybody.
Thank you. You too, Carol.
From State Street.